Hey guys, I wanted to do a little section on when you should grow. It's a very important question. I think there's a lot of love for growth. If you think about CEOs, they're always planning growth and expansion. But growth is not, oh, you can achieve growth. You can go out and you can buy other buildings, you can buy land, you can buy equipment, you can increase your sales. But should you grow? Is that growth, you will actually grow, but are you actually going to be improving the value of the ownership stake of your shareholders, for example? Is your price going to go up? Or actually, are you, by growing, hindering your price? Is it actually lowering your price when you choose to grow? That's possible. So let's think about, when is growth actually a profitable endeavor? Okay. To do that, we need to remember, price of a stock or ownership claim is going to be based on the future cash flows that can produce for you. And those future cash flows are coming from two things. One is going to come from the assets in place, right? If I have a machine that produces 1,000 widgets, I already have that machine and I maintain it. Let's say it just keeps producing 1,000 widgets forever. Okay, so those are what my assets in place. And I could take the earnings from that machine and I could pay whatever free cash flows that machine produces, I could pay it out to the shareholders. Okay, I think dividends. Okay, but so my assets in place are producing cash flows for me, and they can produce those forever. But because we're thinking about all future cash flows of a business, right, we also should think about the growth in those cash flows, right? And that's where we decide whether we should grow or not, right? So assets in place are producing cash flows, and then some of our future cash flows are going to come from growth. And growth comes from reinvesting some of the earnings into the business. And the question is, should you be taking shareholder earnings, right? The earnings from that existing machine that produces 1,000 widgets. Should we be taking those free cash flows and paying them out? Or should we be reinvesting them in the business in order to achieve our growth, right? Growth has to come from reinvesting into the business. You have to take some earnings and you have to buy an asset, a new machine, a new piece of land, a new building, right? That's how you grow. You reinvest earnings. And the question for growth is it good? Is it a good idea to reinvest the earnings, or should you be paying it out to the shareholders? Now, the shareholders are thinking about this decision in this following way. If you give me the money, right, I can buy another project, say a basket of public stocks that's going to be very well diversified, and it's going to give me a certain return. It's going to have maybe similar risk as your project. Okay, so there's outside options for the shareholder. If you give me the money, I can do this. If you reinvest the money, you will do that, right? And so we're going to compare the two choices. If you give me the money as a shareholder, then I'll go buy a basket of securities and I'll earn a good return. I'll be very diversified. It'll be very liquid. If I give you the money and as a manager, and you take that money and you reinvest it in the business, you're also going to earn potentially a return. And now I just want to compare the returns I can earn on these two options, right? Here's my outside option, which say buy the market index, like the S&P 500, and here's the other option, which is I give it to you and then you invest and in the firm to achieve some growth. If you can earn a higher return than I can earn over here, holding the market portfolio, which is a very easy outside option for me, then I want to give you the money. But if you can't, then I don't. And so that's captured here. The price of a stock, call it P, is just going to be equal to the earnings that you're already producing. So think about your earnings per share, right? What are the earnings that this 1,000 unit machine is already producing? Okay, and if we have no growth, we're going to have those earnings forever. And the way to value that is just to do the perpetuity formula. You take the earnings every period, which I'll just call it earnings per share, and you divide it by the discount rate or the required return that investors have. That takes into account the time value of money and the risk of the project, right? But this is a shorthand. It's called a shortcut called the perpetuity formula for valuing an infinite stream of earnings, right? So that machine will keep producing earnings forever. Now, what is the value of that asset that's already in place? As I said, the price of a stock, which is P, is also a function of your growth. So PVGO here is the present value of the growth opportunities, or what is the present value of all the growth in cash flows? So we know what the existing earnings are, and what's the value of all that increase in growth in the earnings that we expect to receive. Well, here it's captured into intuition I already shared with you. You are only going to actually have a profitable growth for your firm. That means you're only going to have this when the return you can earn, ROE, is the return on the equity you're investing in the business, right? if you look at the parentheses here, if you look at the return on equity, and if you compare that to the required return, which is R, right? What's the outside option for the investor? If your required return on equity is higher than R, then you're going to have a positive expression for the present value of growth opportunities. And the price of the stock will go up as you reinvest, okay? But, and this is true for many firms, and I'll give you some examples, right? If the return that if the return that you're earning on this equity is actually less than the required return, what's going to happen? You're actually destroying value. You're keeping the money from the shareholders that want to have this easy outside option of, say, buying the market. You're keeping the money from them, and you're earning a lower return. The shareholders don't like that, right? And so your price of the stock is not going to reflect it's going to reflect the fact that you're actually destroying the value. You're allocating capital poorly. In fact, if you stopped growing, and perhaps if you shrunk, the price of the stock would actually go up. And there's an interesting example of this. Recently, if you look at Luby's, L-U-B, they're a restaurant company in Houston. They do like these little cafe kind of style restaurants. And they've been suffering for a long time. Then this coronavirus pandemic hit, and they were in a really bad shape. The stock actually went to like, say, 50 cents. And then all of a sudden they announced that they are going to liquidate the entire business. So they had owned all their real estate and assets, and they're going to sell those, liquidate, sell the real estate, and then just distribute the money to the shareholders, right? And that's exactly this example, right? If you're a restaurant company in a pandemic, first, you shouldn't be growing, right? You're not going to be growing profitably. The return on equity you're earning during a pandemic is going to be, the coronavirus pandemic was pretty dismal. And so you should not be growing, obviously. In fact, you should be shrinking. And what happened when they announced that they were going to liquidate is the stock price went from 50 cents immediately to $2, and actually has since then gone up quite a lot, and they've paid liquidating dividends along the way. But the market was happy to hear actually that they were accelerating the shrinking of the company, and they rewarded that with a higher price. So there's many case studies like that, where if you actually allocate capital smartly, you can actually benefit your stock price, which could benefit your compensation if you're owning one of these firms as a shareholder or as a CEO, and you also have a shareholding stake. Right? You can actually increase the value of your holdings by actually shrinking the business, even though that's not so so exciting, and you can't brag about how you're shrinking, perhaps. But right, if you do the smart thing, actually, the price of the market will reward you with a higher price. So the important things, just to recap, are that price of an asset is the future cash flows, which includes the cash flows you get from existing assets in place and the increase in cash flows you expect as you grow. Growth comes from taking cash flows away from the shareholders. The cash flows you generated today, I'm going to take some of them away. I'm going to put them back into the business. I'm going to buy new machines. Right? If you take money away from the shareholders and put it back into the business, then the shareholders are thinking about, are you earning on that reinvestment in the business as much as I can get on an outside option, like buying the market? Okay, and very intuitively, if you can earn more relative to my outside option by putting the money in the business, then I want you to do that, and I will actually give you a higher price. I think that growth is wonderful. Please take my shareholder earnings. Please plow them back into the business. But if the return that you're earning on the equity that you're keeping from me is low, then I say, gosh, please stop. Give me the money back. Let me put that money in my other outside option. Let me redistribute that somewhere else, because you should not be investing that capital. And again, if you actually stop growing, right? So this point is that the assets in place are earning a certain value or contributing to the value of your firm. The growth is contributing, but if the growth is if the growth is suboptimal, you're actually destroying value. The price is actually lower than it would be if you just stop growing. And actually, if you go in reverse, it could even increase. So this is very important. I think there's so much attention on growth, but very few people understand what it really, these very simple, intuitive points, okay, about you're taking money from shareholders, you're putting it into the business. You need to think about the return on equity relative to what the outside option is, okay? That's the very important point, is relative to. Okay, return on equity, so what? That's just telling me what you earned. And then I want to say, well, what was the expense that you earned for that equity? What's the cost of that equity? Well, I'm thinking about that as my outside option. instead of earning this other thing on the outside, like holding the market, I gave you the money, right? And so I don't care if you're profitable with a positive return on equity, and people talk about that all the time, but I don't care about that number. I care about that number relative to what you should have earned. What was my required return for your business? What was the outside option where I could have put the money in a market index? Okay, that's the important dimension, and almost always forgotten, right? I don't care if you're profitable. Don't go and celebrate that. I don't care what your net income is on the income statement. I care about what you should have earned. What should your net income have been given my required return for the business? Okay, that is what I care about. Okay, thank you so much.